Hi and welcome. This is our channel TFS Consultants, and today I wanted to talk about and to really come to a director or a small business that is struggling with cash flow. I've spoken about this previously, but I wanted to expand on this and really to aid somebody who is struggling with their cash flow. So you are a business director or you are a small business that is profitable on paper. In your financial statements you are profitable, but in your bank account as the director you know that you are struggling, you are failing to pay maybe your VAT payments, your SARS, your employees, even when your expenses as they are coming. Then it is you that I want here, and I hope even to those that also want to get into business or they're just directors for small entities, they're not experiencing this. It's very, very important you listen to this, because I think this is one of the most important videos that will help SMEs that we have done here at TFS Consultants. So my topic today is your business is profitable. So why your business is profitable, but you are cash flow trapped, or you are lacking in terms of cash flow. Or let's put it bluntly, it is that your business is broke. So why your business is profitable on paper, but cash flow wise your business is broke. Why is that happening? So we're going to talk about the hidden cash flow trap destroying most South African SMEs and how your business can escape it. So last time I just talked about what the cash flow trap, the cash flow issues, cash flow management and stuff like that, and it was just in general what people and business can be facing. But in this episode I really wanted to get deeper for you to understand where your business and your actions may be lacking and why you are in the situation that we're talking about. Because it's usually coming from certain behaviors or certain issues that you need to just get rid of. And if the moment you get rid of, within 2 months your business will be viable, your business will be doing well. So I'm going to start by describing a business owner that I know. I will call it a fictitious business owner that I know. But this is a story for most businesses that we encounter, especially SMEs. So this is not a real company that I'm talking about. It is a fictitious make-up story representing what we usually see in the market. So let's take a business owner, a director. His name is Sipho. He runs a retail business in Johannesburg. And his last financial year, or last financial year 2025, his revenue was 3.2 million, which means revenue wise is doing well, is growing, is a small business, so he's fine. And his profit margin, which means his revenue less all his expenses, what is left there, his profit margin was actually 22%, which is good. For a small business of that nature, you're retaining 22% on paper. That's what you are having. And his accountant just told him he had a great year last year. But he himself knows his bank statement. And that bank statement tells him a totally different story from what the financial statements and the accountant is saying. In October, Sipho couldn't make payroll, or he couldn't pay his salaries to his employees. He was struggling. And not because maybe his employees did not work, no, they were actually working well. And not because his clients had not paid him really. It's a big reason there, but it's not really about that. So he couldn't make his payment for salaries because 487,000 of his own money was sitting in a SARS account, or an account that he usually pays SARS over. Usually pays from to pay SARS for VAT, because it's a VAT registered company. So money he had collected on SARS, or on behalf of SARS, which is VAT, what VAT really works like. So he had collected money, and that money was for SARS. It was on behalf of SARS. And his VAT return was now due in the next 11 days. So he need to pay that 487,000 over to SARS within the next 11 days. Which means that 487,000 was untouchable. He has to pay it over SARS. Otherwise, he start accumulating serious penalties and interest and stuff like that. He can't use it to pay his employees. But meanwhile, his biggest client was sitting on a 900,000 invoice that Sipho has done through his company, has done the work, and that invoice was now due for 62 days. It was now overdue 62 days. So they have not paid. They were supposed to pay 62 days ago. They didn't pay. And that's what is also destroying Sipho now. So Sipho's business was profitable on paper. He was technically, measurably, demonstrably broke in reality. But on paper, he's fine. So we're going to talk about this story. And this story is not about Sipho's bad luck. No. It is not about maybe his bad businessman, or he's a bad businessman, or bad business behavior, which I would say yes to some extent, but it's not really what I'm talking about. His story is about a trap, a structural, a mathematical, and almost invisible trap that most business owners do not see, that actually catches almost all small to medium enterprises. And today, in this video, we are going to really discuss, and I will show you exactly how it works, why it works, and most importantly, how to get out of it. Now, my name is Dumisani Chirisa, and I'm sure by now you know me. I'm the director at TFS Consultants, a Johannesburg-based accounting, tax, and advisory firm. And what I'm about to really talk about in the next 20 minutes is something that almost no one in the South African financial service industry is talking about openly, or is spoke about openly. And for a reason, obviously, because in such ignorance by the directors, it also means more money, more business, more work for most accounting and tax practitioners. But I want to change that, because the business owners who understand what I'm going to talk about, the concept that I'm going to talk about, usually survive. They thrive actually. And the ones who don't, well, many of them close their doors within 3 years of doing business, or 3 years after maybe starting to make some profits. So let's get into it, and we're going to talk about this. So the problems that I'm going to talk about, or the trap that I'm going to talk about, I'm going to discuss it in 3 ways. So there's what I call the three-headed monster, which actually destroys or puts businesses in a trap. Or those are the traps. I call them the three-headed monster. And I want you to listen very carefully here in your business. So the cash flow crisis that destroys profitable South African businesses is almost never caused by just one thing. It is caused by 3 things happening at the same time. And when all the 3 hit together, or they attack you together at the same time, it actually creates a perfect storm for your business that can take down your business that was profitable on paper and was absolutely working fine. But it can be taken down if these 3 monsters are not manageable or managed well by you as the director. So what are these 3 forces, which I call the three-headed monsters? It's the VAT timing, or VAT. It's the debtors days, or some people call them receivable collection days. And the third thing is the provisional tax seasonality, or seasons. So VAT, debtors collection days, and provisional tax. These things can actually destroy your business or make your business. So let me break each of these, and then I'm going to show you how they actually interact, because that interaction is where the real danger for your business lives. Now let's start with the VAT timing. Now the truth about VAT is that most people or most business owners do not understand what it means to be registered for VAT and what they are actually signing up for or agreeing to do, especially when they first register. Because you need to understand this when you are registering. You understand why are you registering, and I mean, obviously you have to register and you get 1 million of revenue going forward, but what are you signing up to do? That's what you need to know. Now, when you collect VAT from your clients, when you are registered for VAT, it means you are agreeing to collect VAT on behalf of SARS. So now on your invoices, you have to increase with a 15% to also collect that VAT part for SARS. Now, when you collect that VAT from your clients, that money is not yours. It is never your money. It never was. You are, from the moment it hits your bank account, when your client pays, you are acting as an unpaid collection agent for SARS. You are holding their money in your bank account when your client pays that VAT portion. You are holding it in your bank account on behalf of SARS, and you have to give it back to them on a deadline, which is usually the 25th of the month following the lapse of your VAT period. So whether or not your own clients have paid you or not, you have to pay that money. So the moment you invoice, you are already owing SARS. Not when they pay. No, when you invoice. Even if they pay 90 days later, it means you are now owing SARS for 90 days or more, and you can be charged penalties and stuff. You have to file and stuff like that within those 2 months. So that's why it is important to manage debtors days, VAT, and provisional tax, which I'm talking about. So by statistics, South Africa has approximately 900,000 VAT registered vendors, and the majority of them operate on a 2-month VAT period. So every 2 months, every you calculate the 2 months VAT, whatever you have to pay, you pay SARS. The next 2 months again, continues like that. So after every 2 months, the next month you should pay before 25. That's the due date. If you don't pay, you get penalties, 10% plus interests. So for somebody, let's say, who has a 1 million invoice, it means that 150,000 of that invoice is SARS money that you owe to SARS right away from the moment you invoice. So regardless of whether your client has paid you, or they are paying in 30 days, or they are paying in 60, or they are paying in 90, or never pays, you owe it to SARS. And that's the first head of the most that I was talking about, the VAT timing. It is sitting there in your business, silent, invisible, but growing every time you are invoicing a client, because there's a VAT component there, and every time you are invoicing, you are increasing that money you need to pay over to SARS. And most people treat that money as if it's theirs. Now he pays his employees, he pays that, and forgets that the component included in that invoice is a VAT component that is SARS money. Now the second head, like I said, is the debtors collection days, or the debtors days. Others prefer to call it account receivable days, and I call this one the silent wealth killer. South African businesses have a debtor crisis, or debtor days crisis, and it is getting worse. This is from statistics. In the South African, or the National Credit Regulator, and actually other various SME surveys consistently show that the average payment period for a business-to-business invoice in South Africa is paid between 45 to 75 days. Imagine, for your business. And if it's a government or large corporate invoice that you have worked and they are supposed to pay you, government can take 90 or even 120 or even 150 days or more to pay you. So imagine you'll be owing SARS, you need to pay, but the money is not there because the government has not paid you, or that large corporate invoice has not been paid. So, like I said, research also consistently shows that late payment is one of the top 3 causes of South African SME failure. So SMEs, most of them fail because one big client or one of their clients is not paid, and that client represents huge money for their business. It's not paid and it's taken time to pay, which usually shuts you off from being able to operate. And yet, it is most entirely, all these things are usually not discussed in the education sector or from your education, from primary, secondary, matric, university. These things are not usually discussed. You just learn business and how it operates here and there. But how these companies can actually destroy other small companies is usually not spoken. You experience it firsthand when you are in business. So what does that mean practically? So it means if your business, let's say, makes 500,000 a month, and your clients take an average of 60 days to pay, let's say 60 days or more to pay you, it means in 2 months you are supposed to be getting 1 million, because 500,000 a month times 2, because that's the VAT period. 2 months you're supposed to get 1 million. So it means 1 million of your own money is sitting in other people's bank accounts or in your clients' bank accounts, because they have not paid you. They pay you 60 days. So you're not going to be paid. It's sitting with them, but it's supposed to be with you now. So that is actually your working capital that is sitting there with your client. And it's supposed to be your payroll budget. That's where you're supposed to be paying your salaries from. That's supposed to be your tax money as well to pay over to SARS. And it is being used interest-free by your clients. And what it means that they will be funding their own operations using your money that they're supposed to be paying. So now combine that with the first head, the VAT timing. So you are collecting VAT on invoices that haven't been paid yet. And remember, SARS say you pay once you have just invoiced. So, and you are going to have to settle that VAT before the payment arrives from your client. That gap between when you owe SARS and when your client pays you continue to widen, and that gap is where businesses go to die, or where businesses usually collapses on. Now, the third head is the provisional tax, which I have already said. So provisional tax in South Africa is paid in 3 installments, usually 2, but usually there's a third one because your estimates obviously won't be perfect. So you're gonna have to pay something or maybe get a refund, but in most cases you top. The first payment, which is the first period amount, is due at the end of August if your business has a February financial year end. So the second one follows 6 months later, which is in February when you're in your end. But the third one is a top up following your assessment. So when you assess, you say that this money that you're supposed to pay is actually more, so you need to top up. So, but the problem is here, most business owners, and mind you, I have sat across the desks from hundreds of them, dealing with them. So most business owners calculate their provisional tax based on last year's numbers, which is the starting point, or they estimate as conservatively as they can, because they don't want to overpay or they don't want to pay much. So they estimate that this year we'll make small money. And then the business grows during the year more than what they had estimated. Revenue goes up all of a sudden, they got some contracts, they got some clients. Profit also goes up, and the provisional tax liability that SARS expects from them also grows up. And now remember, you estimate, and if your estimation is not within 80%, is more than 80% or 20% of from what you had estimated, you start to get penalties as well. you start to get penalties. So think of that. So the provisional tax liability that SARS expects from you as your business grows, but the business owner or bank account or bank balance doesn't grow at the same speed, because remember, the debtors take more time to pay, and the VAT timing also on the other hand. So let me now put all these three into perspective for you to understand more. So let's say it's October. Your VAT return is due. You owe SARS 320,000 in VAT. Simultaneously, your provisional second period payment of 180,000 is also due next year, because remember, it's October. You have just done your August thing, provisional tax calculation, and your biggest client, who owes you about 730,000, has just informed you very politely that they are experiencing a cash flow crunch of their own, and will be paying you in the next 45 days. You have 210,000 in your bank account. Let's say you cannot borrow quickly, especially for such things. You cannot sell assets quickly to cover that. You are profitable in your financial statements. You are solvent according to the mathematics there, and you are about to miss a SARS deadline, because definitely you don't have the money. So what happens when you miss a SARS deadline? And I'm going to briefly talk about that, because that's section 3 of the Income Tax Act, and it is where it also gets really important. So there is a widespread misunderstanding about what SARS penalties actually cost you. And the reality is significantly more frightening than most businesses or most business owners know. So let's talk about, first of all, the late payment interest rate. So SARS charges interest on late payments. At the current prescribed rate under the Tax Administration Act, I think as of 2025 and into 2026, the rate has been sitting above 11% per annum interest on what you are owing. So, which then obviously compounds and applied to larger debts. If it's applied to larger debts, this interest rate, it creates a serious financial burden very quickly, because for big amounts that can be significant. It's also only not insignificant when you're dealing with some small amounts. But interest is the latest, the least, actually, if I can put it that way, that you should be worrying. Because at least that interest is charging every time you are not paying. But what is of importance is administrative penalties. And these ones kill a business. These ones can actually kill a business, especially if the business is supposed to pay huge amounts. So under Section 213 of the Tax Administration Act, SARS can actually impose administrative penalties for non-compliance. So for VAT, for example, the late payment penalty is actually 10% of this outstanding amount. So let's say you are owing on an amount of 320,000 VAT liability. It means 32,000 of late payment you have to pay. It is gone instantly. It's just a penalty, not a tax. It's just a penalty for you not paying on time. So not something you get credit for paying. They're actually penalizing you. Just gone like that. So imagine if you've got a million rand that you have not paid. That's 100,000 there, gone. But here is what most people don't know. If you have been non-compliant before, even once, SARS, usually, especially their automated systems, can actually flag you now. Your risk profile changes. Your chances of being selected for an audit usually increases, a SARS audit. And a SARS audit, even when you have done nothing wrong, is one of the most expensive things that can happen to a small business, especially when when you're involving big amounts. The time it takes you or it takes to respond, the professional fees for representation, maybe by tax practitioner or whatever, the distraction from just running your business, all those, it's money, it costs. The indirect cost of SARS audit, for example, for an SME can easily run into six-figure amounts. Now, here is the trap inside this trap that I was talking about, the three heads. When you can't pay your VAT on time, you might try to make a payment arrangement with SARS. And this is what most of my clients, some of my clients also say, hi, you know what, I can arrange what we call payments and stuff like that, an arrangement to pay SARS. But SARS does not offer these. And here at TFS Consultants, we help clients navigate them regularly. But a payment arrangement means you are now paying your current taxes, you still need to pay as you are calculating, and your historical tax debt simultaneously now. It's now two things now you need to pay. See, your business is already under strain, you now need to start paying double or two things at one go. So effectively doubling your monthly tax burden at exactly the moment when your cash flow is already under stress. You are failing to pay. Now you have to pay your current ones plus whatever you have agreed to paying on the debt that is coming from the days before. So many businesses that end up payment arrangements with SARS find that double burden pushes them into a second cash flow crisis, which they usually do not survive, leading them to missing those payments and then obviously to fail, and or still having this huge SARS debt. So according to SARS, tax debt outstanding from smaller businesses represents about billions of rands of money being owed by small to medium enterprises. Much of it from these ones, the startups and stuff like that, and businesses that were never trying to avoid paying tax really, but because they've been caught in this trap, the three-headed trap, they simply run out of cash at the wrong moment. So the monster doesn't care that you are a good person. It doesn't care that your business is fundamentally healthy. The monster, which I mean the SARS monster, obviously, is mathematical. In mathematics, without intervention, always wins. So what do you do about all this? What should you do now? So let me give you the TFS Consultants framework, our own framework in managing all this and getting out of this and permanently avoiding this trap. So because this is solvable and the solution is not complicated, but it does require some intention and it requires doing it before the crisis hits and not after. So over the years of working with a lot of South African businesses or business owners across different industries and different sizes, so I can say from sole proprietors to companies that are turning over 500 million, 30 million, 20 million, 1 million, whatever, in a year. Here at TFS Consultants, we have developed what we call the cash flow architecture framework. It's our own template, obviously. It has 4 pillars, and when all 4 are in place, the three-headed monster becomes manageable. And when even 3 of the 4 are in place, you significantly reduce your vulnerability. So let's get into that. So the first pillar that we want you to do as a business owner, to make sure that the three-headed monster, you deal with it and deal with it forever and you not struggle and you have perfect working capital reserves, working capital management, and your business thrives. The first pillar is the SARS reserve account. Treat tax like rent. You know you can eat your rent money. Exactly. So that's the first one. So the single most transformative habit any VAT registered South African business can build is this. On the day you issue an invoice, transfer that VAT component into a dedicated separate bank account, or maybe core account if you don't want to open a separate account. Not a mental note to say I need to remember, no. A different bank account or in a core account. Not a spreadsheet entry, an actual physical transfer of funds into an account you do not touch for any reason other than paying your SARS. This actually sounds simple, I know, but it's not simple. It is maybe I can call it easy if you have done it correctly. And it will change your financial life more than almost anything else that you can do in your business. Because the moment you treat VAT as money that was never yours in the first place, the moment you remove it from your operating account on day one, it stops being a liability that surprises you. Like, hey, I need to pay that now. And it starts being a scheduled payment you have already made. So you put it aside, when time comes, you pay. If it happens that maybe you manage also to have expenses that you can deduct and you still pay, you're gonna pay less, then that's good, that's a benefit for you. But this is not your money, this is SARS money. Do the same also with provisional tax. If your accountant, for example, tells you your estimated annual tax liability is 600,000, divide that by 12. That's 50,000 a month. Transfer it every month without exception. When the provisional tax deadline comes, you don't scramble, you don't say what, you transfer from that reserve account and you continue operating normally. The second thing that you need to deal with is, or you need to also ensure is that is to ensure a 30-day data enforcement system. 30 days data enforcement system, not 60, not 90. Your debtors should pay within 30 days. So your debtors are not your friends. Your clients are not your friends. When they hold your money for 90 days, you collapse if you leave that to happen. So I want to say that clearly and without apology, because South African business culture has a deeply uncomfortable relationship with this conversation. We don't want to be aggressive. We don't want to damage relationships with our clients and stuff like that. And so we wait politely while our working capital is held hostage. Because if a business agrees to have your services, and then when it's done, they don't pay, they are holding your money hostage and they are holding your business hostage. So here is what a professional data enforcement system actually looks like. Day one, invoice sent with crystal clear payment terms on the face of the invoice. Clearly, 30 days, no exceptions. After 30 days, it starts to accrue interest. That's what you do. After 30 days, it means it starts to accrue interest, and you calculate it, and you also put it on the invoice that when it's more than 30 days, interest at the rate of 11% or whatever, so that they know that the interest will be growing up and it will charge you. Day 25, after the invoice has been sent, send an automated reminder, not an apology or apology, not being apologetic, no. Professional, factual. Your invoice falls due in 5 days. Please confirm payment details. The day 31, a follow-up call, not an email, a call, a phone call from a real person. Day 45, a formal letter of demand. You see, they know that This is more like you are keeping file for even a court case. Day 60, the matter goes to your attorneys or a collection agent, plus the interest over the period. So most business owners never get paid by 31. They send a polite email and wait. And the debtor, who is also managing their own cash flow, will always pay the squeakiest will first, obviously, the ones that are fighting. So be that squeakiest will, be that irritating client or company that needs to be paid, and do it professionally, do it consistent, and do it without guilt. You did the work, so you need to be paid. You deserve to be paid, and your employees who need their salaries deserve it even more. So there should not be any two ways about your payment. Now, the number 3 is what I call the provisional tax calendar. Work with the cycle, not against it. Work with the cycle, not against it. Most businesses or most business owners experience provisional tax as a surprise twice a year. So they're just like, oh, provisional tax. No, you need to have it as a calendar and you know it. So this is an information problem, I think, not an accounting problem, really. As a business owner, you need to know that. And here at TFS Consultants, we build for every client what we call a tax event calendar. A 12-month forward review of every tax obligation, every deadline, every VAT filing date, every payroll submission, and every provisional tax payment due. We map it against that client's anticipated cash flow so that we plan accordingly and when they pay. So when you see on the 1st of January that you have a 280,000 provisional tax payment due in August, you have 7 months to prepare for it, and you can even set up small amounts to it. You can plan a revenue push. You can time a large capital purchase to reduce your tax or even a taxation taxable income legitimately. You can arrange a short-term facility with your bank, not in a panic, but strategically, really, and with full documentation at a reasonable rate, because you are not desperate. So the business owner who plans for tax is a completely different animal from the one who discovers it and gets shocked, like, provisional tax. No. And your accountant's job, which means your TFS Consultants team's job, is to make sure you are always the one who planned for it. So plan for that tax, and we can help you plan for it. The 4th pillar is what we call the business health check. Every year, every single business, regardless of size, regardless of profitability, should undergo what we call a business health check. This is not your annual financial statement. Your financial statement looks backward, but a business health check looks forward. So it asks questions like, is your business structure still optimally tax efficient? Are you maybe trading through the right legal entity? If you are a sole proprietor, maybe turning over 4 million a year, you may be paying significantly more taxes than a director of a PTY with equivalent income. So you may be needed to register it as a company. Is your SARS e-filing profile up to date? Are your company secretarial records current with SIPC? Is your director information correct? Outdated SIPC records are one of the most common issues, even of penalties and stuff like that. You need to avoid that. Are you claiming every deduction you are legally entitled to? Things like home office deductions, vehicle usage, business travel, Section 12C accelerated depreciation on equipment, and things like that. These are not loopholes. These are designed features of the South African tax code. They are there, and if you are doing that, you can also utilize them, and they are available to you, but only if your accounting records are clean enough to support the claim. So the difference between a business that struggles with the three-headed monster and the one that has tamed it is almost never about intelligence. It is almost never about your hard work. It is always the structure, the architecture of how you manage money between the moment you earn it and the moment SaaS takes its share. That period, that's what is important. Now, I also want to take this moment to address something that is specific to our context as South African business owners and directors and stuff like that. Because this cash flow problem exists everywhere in the world, but in South Africa, it is amplified by factors that are also unique to us or to this country, and those factors deserve to be named. And some of them at the current moment, they may be slightly better. So first is load shedding and infrastructure instability. So because when you are operating as an SME, you may likely be already at a disadvantage because of these factors. So every hour of load shedding costs your business money, your business productivity, in generator fuel, in lost transactions, lost business hours, and lost work. That is real, recurring drag on revenue that is absent from most international businesses. So that's why I'm saying you are already at a disadvantage. It means your margins are almost always slightly worse than your projections. You may say, I want to get this money, but because of these things that are unforeseen, you may end up worse off, which means your cash buffer is almost always slightly thinner than you had planned. So the second thing is obviously the credit environment in South Africa with the banking system and stuff. Unlike business owners in the United States or United Kingdom, or South African SMEs face a banking sector that has historically been deeply risk averse, especially when it comes to SME lending, because of collateral most SMEs do not have. Getting a working capital facility, the kind that would bridge your debtors gap and maybe to pay SARS and stuff and other things as they come due whilst you're waiting for your clients to pay. Usually all those things often require collateral, some property, some track record, and some documentation that early stage businesses simply don't have yet because they are small. So this means that SARS reserve account isn't just a good practice, the one that I was talking about throughout. Isn't just a good for many South African business. It is the only viable safety net that most small enterprises in South Africa would have, because the bank won't lend them to cover for that VAT, or would have to have connections, or sometimes even race in play there. The third thing, SARS increasing sophistication. We can never run away from it. If you've been following the news, you hear that SARS has invested heavily in its digital infrastructure and data analytics capabilities. So the days of errors going unnoticed are somehow coming to an end. SARS, AI, and data matching systems are increasingly able to identify some discrepancies between what you declared and what your bank records, your customer records, and your supplier records show. It's going to come to a point where they can detect all these things. So this is not a reason for you to panic as a business owner, but it is a reason to have clean, professional, and accurate records, which is ultimately what your accountant is there for and what we are there for. So SARS collected over 1.73 trillion rand in the 2023-24 financial year, which is the highest ever collection. So the compliance environment in South Africa is tightening the loops. It is managing to collect even more now, and it's not actually losing on this. So the business owners who will thrive in the next decade of South Africa's economic life are the ones who treat compliance not as a burden, but as a foundation for their business. Because a business built on clean books, proper structure, and proactive tax management is a business that can raise capital, attract investors, survive audits, and sleep at night without stress. And that is exactly the kind of business TFS Consultants was built to help you create, or is there to help you create. So we have covered a lot of ground in this video. So let me also give you the 3 things you can do before you close this tab or you move to the next video. Number 1, open a new bank account today, or utilize your core account or your savings account, whatever. But I would recommend for you as a business owner to open a new account, separate account, bank account today. Call it your SARS reserve account. The moment your next invoice is paid, transfer 15% of the VAT exclusive amount into that account. Also pay there some VAT payments, for some provisional tax payments as you are preparing and building up to pay your provisional tax. So this will be for your SARS stuff. Do not wait until next month. Do not wait until things feel more financially comfortable as a business. Open the account today when you hear or when you found this video. Even if it sits empty for some weeks, the habit of having it is the beginning of your financial transformation and the beginning of you moving out of the 3-headed trap that we discussed. Number 2, look at your age analysis right now. Pull up your debtors list. And find every invoice that is more than 30 days old and has not been paid to you yet. Add them up, all of them, all those invoices. Whatever that number is, that amount is, that is the money you have earned that is not in your bank. Make one phone call today about the oldest one. Not any invoice, not any email, a call. You will be amazed what a phone call accomplishes that an email doesn't. So number 3, book a business health check with us here at TFS Consultants. Go to trayfinserve.co.za. The link is in the description below. Our team will sit with you, review your current structure, your SARS obligations, your SIPS status, your accounting records, and your cash flow position. We will tell you honestly where your vulnerabilities are and what it is that you can do to close those vulnerabilities. That conversation obviously will cost you nothing, especially if you are comparing what you will be losing throughout the years if you have not done what I'm saying. Not acting on it might actually cost you everything in the future. Remember SIPO, the one we talked about when I was starting this video, the business owner that I talked about at the beginning of this. He is at TFS Consultants and he is a TFS Consultant client now. We restructured his VAT management. We implemented a data enforcement system for his business. We built him a tax calendar which he follows and a reserve account that he opens separate for SARS payments and SARS money. And last October, for the first time in 4 years, he made payroll without stress. He settled his VAT on time and had enough left over to take his family away for a weekend. His revenue didn't change much. His clients didn't change much. His industry didn't change, obviously, but his structure changed. His systems changed. And that made all the difference. Your business is profitable. You may not see it. It deserves to feel that way. and with the right architecture in place, it will. And we here at TFS Consultants, we are there to help you and your business come to profitability and to good capital management, cash management. Thank you for watching, and please subscribe, follow, share. Until next time, bye.